morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah. You're watching Indian Open. Let's go straight to the headlines at this hour. A one-on-one meet over Donald Trump and Kim Jong-un's advisors join in for the bilateral talks in Singapore. Asian markets make some steady gains after opening flat as Trump and Kim seem to hit it off in Singapore. Transport infrastructure consultancy writes will kick off the government's divestment plan in the current financial year. Fortis Healthcare's board defers accepting the financial results till June 25th, also allows final bids to come in till June 28th. Well, it promises to be an interesting day of trade, considering the worst of the fears for now don't seem to be turning out to be true. The world markets are doing reasonably okay. We'll talk about that in a bit. First, the trade patterns and the trade setup for the day today. Remember yesterday's session, the bulls might have been a bit disappointed towards the close because while we started off really well, we did come off and the trade was indicative of nervousness at certain higher levels. We ended about 19 points higher at a point of time. We were about 2/4 or 3/4% higher. So it was a very strong show for most part of the trading day, but for the last 45 minutes of trade. Cash market volumes may have been lower, but there was a fair bit of selling that we saw from the FIs in the session yesterday. Remember, 26,000 and about 2,500 crores of cash market volumes. But look at the sell number from the FIs, fairly high, 1,157 odd crores. So the volumes were lower, but there was quite a bit of selling that came in on the cash market side. And on the FNO side, remember, if Friday was a day of fair bit of option writing and therefore some bit of hedging, yesterday that activity was muted, but enough and more activity on specific stocks. So, I mean, forget the fresh longs in RBL, that was fine. But if you, and I know Navneet and Agam will join in and talk about this in greater detail as well. But if you just look at the fresh short positions that were built in a clutch of consumption and consumption related names as well. Pidilite saw some fresh short positions. Castrol saw that. Exide about 8% kind of short build up that happened as well. And a couple of stocks may have seen some short covering. But fair bit of activity that we saw on the short side in a lot of mid cap names. The market breadth was positive yesterday, but it closed in favor, or rather the gap closed in between the advances and the declines in trade yesterday, and that was really the standout takeaway from the trading pattern yesterday. Now, whether or not will we see some bit of reversal remains to be seen. Today the world markets would have been waiting for what will come out of the Donald Trump and Kim Jong-un summit, then the Fed, then the ECB. So lots to watch out for. We're starting off on a skittish note. The world markets are flat to marginally in the red. The SGX Nifty 2 indicating a start which might be marginally in the red. So, well, let's wait and watch. Maybe the outcome and the definitives from what happens from the summit today, from the Fed tomorrow, will all give some bit of direction to our markets. Specific stocks, there aren't too many which will react. I've tried to pick up 2 or 3 today. Maybe a lot of reactions would be on stocks that have done well yesterday or come off from the highs yesterday. But on news, I could at best manage 2 or 3 mid caps. Welspun Corp, you remember they got an order over the weekend. They've got another order worth 400 crores, approximately about 400 crores, give or take a few here and there. It's calculated out here. But let's see if it has a further reaction. KDDL, it's a mid cap play which has had a fair bit of run, then a bit of a pullback as well. They're going to raise the FPI limit up to 49%. They're going to raise about 30 crores by equity. It's a very small equity, by the way. So for them to raise 30 crores is sizable. Let's wait and watch what happens to KDDL, if anything. And I thought amongst the brokerage notes, there are 3 or 4. CLS has written on pharma, a couple of others. But I thought this Kotak on Max Financial was interesting because Max is a stock in news. They are saying that there's a high probability for the Max Access deal to extend beyond FY21. Remember, it's very crucial for Max to have this. So let's wait and watch. Bank assurances are fairly important. Bank assurance partnerships are fairly important. So Kotak is betting on this high probability of the Max Access deal to extend beyond FY21, and therefore they expect positive near to medium term stock performance. Kind of stood out for me. There are some others, of course. This is not the only one. But let's wait and watch what happens to Max Financials in the session today. And then, of course, a clutch of other momentum boys. We'll talk about some of the stocks on which there was some short and long build-up as well with a lot of our experts. But that's not that we have on First Word. That'll happen a bit later on. What do we have on First Word? It's a collection of the top editorial stories. And Stephen Engel joins us from just outside the venue where Donald Trump is meeting Kim Jong-un for the latest from the Sentosa Beach Resort. Back home, Bajaj Finance stays within the top Nifty performers this year. What is keeping it there? And then come Thursday, everyone will turn focus to Russia as the FIFA World Cup kicks off. We get you today, tomorrow, and on Thursday what people are saying about. In today's session, we get you what UBS and Commerce Bank make of who can lift the trophy this time around. Okay, it's finally happening. US President Donald Trump and North Korean leader Kim Jong-un kick off the historic summit, a first step towards possibly ending decades of enmity between the two countries. The two men opened their highly anticipated meeting in Singapore, marking the first face-to-face encounter between a sitting US president and a leader of North Korea. Stephen Engel, who's been there, remember he was with us yesterday as well, he joins us from the Capella Hotel on Sentosa Island where the discussions are currently underway. Stephen, everything going according to plan so far? I think we just lost Stephen. Anyways, we'll get him in moments from now and try and figure out what is it that he has to say. Remember, I mean, a win means different things to both Donald Trump and Kim Jong-un. I mean, for Kim Jong-un, it may already have been achieved because as long as he can avoid an acrimonious collapse of the talks, that's a victory in itself for Kim Jong-un. For Donald Trump, normally people would have anticipated just a basic outcome to work well. Just the fact that Donald Trump has said so much about what he can achieve via this meeting has set the bar higher. But let's get in Stephen Engel. He, I believe, is now with us. I believe we've connected to him. Steve, good morning, and thank you so much for joining in yet again. This is Neeraj here from the Bloomberg India studios. Everything going as per plan so far, you think?
Well, that's an interesting question, because when you ask me, have things gone to plan, that's assuming that we know what the plan was. We didn't know what the plan was, other than that they were going to have a handshake, and they did that at 9 a.m. In fact, they had about 3 different handshakes to different cameras and different awkward smiles, and then they retreated to talk one-on-one, and then they've had the long tables across each other. We're getting a few comments from the bilateral agreement or bilateral meeting. There should be a statement later. We're not sure about that yet. We also know that they are going to be or have already taken a tour around the Capella Hotel together, which is the building behind me here. They were going to walk around and take a tour and kind of have a little bit of a chit-chat. So far, what we've heard from the two gentlemen, not necessarily as warm and fuzzy and huggy as we got from Moon Jae-in, the South Korean president, and Kim Jong-un, the North Korean president, at the DMZ, where they talked about, a new, warmer spring in their relationship. This is a relationship between Donald Trump and Kim Jong-un filled with past animosity and really sharply worded insults to each other, whether it was a dotard coming from the North Koreans talking about Donald Trump, or whether Donald Trump was calling him Little Rocket Man. They have a lot of history to repair in a very short amount of time. And my initial take is that they, were kind of half smiles in the opening few minutes.
All the Bloomberg articles, Steve, is talking about how a victory is completely different in terms of equations for both Donald Trump and Kim Jong-un. For Kim, as long as he can avoid a collapse of the talks, that will come out as victory. For Donald Trump, a victory out of these talks would be a lot different, right?
Yeah, that's right. I mean, everything really hinges, according to the United States, on the D word, denuclearization. And also, North Korea has to give some sort of indication, according to the United States, on a timetable for denuclearization before it will even consider the other things that the North Koreans presumably want. And that is, of course, relief on sanctions, but also assurances that their regime will remain and that the United States is not intending to try and overthrow the Kim regime. Well, we heard from the Secretary of State of the United States, Mike Pompeo, yesterday saying that they were going to offer up a unique approach to obviously calming North Korea's fears that the United States will push for a regime change. And he said we need to make sure that the North Koreans are are assured that this whole episode will not end badly for them. But it all comes back to denuclearization. And very interestingly this morning, in those cross-table talks, we heard a question delivered directly to Kim Jong-un about denuclearization, and he did not necessarily answer it yet.
Okay. It promises to be a busy day ahead as well. We won't take more of your time. Stephen Engel, many thanks for joining in today and giving us your thoughts. Really appreciate it. That's probably all that you need to know from what we have until now. Let's wait and watch some outcomes a bit later on. Remember, a battery of experts joining in across the network on Bloomberg, and we'll get you all the key noises or the key voices with their thoughts on what the outcome of the meeting would mean for equity markets as well. And for more on this story, log on to BloombergQuint.com. The cover story is on this meeting and all the live updates being put on as we get to know about them. The entire network behind this, so you get updates from Hong Kong, Singapore, India, and everywhere else that Bloomberg Network is present. So do stay tuned for all of those updates. Okay, so that's part one of the big global story. Now we're taking it back home for stocks which are doing well. Remember, we've been trying to get you updates about specific pockets which are doing well. It can't get bigger than Bajaj Finance this year. It makes it to the top 5 Nifty gainers this year. The NBFC stock return is only second to Kotak Bank in the financial space in 2018, and it's continuously hitting new highs. It hit a new high on Friday in yesterday's session as well, continued its merry ways. So I thought I'd just try and piece together what is it that is keeping the stock at such elevated levels. Well, there are multiple reasons. I've tried to piece together a few. Now, remember, first, before I get to the reasons or what works for the company, a hint on the valuations. It trades at approximately 6.5 times FY19 price to book and trades at about 5.5 times FY20 expected price to book. This isn't cheap by any stretch of imagination, but the juggernaut continues to roll on. So what's working for Bajaj Finance? Cross-selling, I think it's emerged as a one big factor. Now, just in case this graph confuses you, let me try and put this into perspective. 73% of the 6 million new customers in FY18 percolated to cross-sell franchise base. Now, just look at this chart. This is we've borrowed from the Jefferies report, and across spheres, it shows you how the quantum of customers who are now cross-sold products are only increasing. The gross cross-sell franchise numbers, that is the first bar, it has moved from 60% to 72%. The non-delinquent customers for Bajaj Finance have moved up from 57% as of FY15 to about 66% as of Q4 FY18. For the year, the average may be slightly different, but the non-delinquent customers have come off as well. And the cross-sell client base in FY15, which is the first bar in the third cluster, which was 48%, has moved on to 59% as of Q4. So you just see the extent of cross-selling that Bajaj Finance is able to do across verticals and across the pockets where it lends. It started off as this consumer durable financing play. It's now gotten into a lot more, and that's the strength, that it is able to keep the delinquencies low and then cross-sell, which only speaks about the quantum of the runway of growth that stays for Bajaj Finance. They are broadening the growth as well. There is growth kicking in the SME book. Almost all brokerages have said that. They have said it in the conference call, in the interviews as well. Their ambition is to be in 16 or the 16 or 17 states in the rural business itself in the near term, and they aim to the distribution network to increase to about 1,550 locations from the current 1,330 locations. That's about a 15% uptake on what is arguably already a fairly large distribution network that they already have. Then the asset quality. Remember, I was speaking about delinquency moving low, but I think the biggest factor for Bajaj Finance in Q4 was that the asset quality improved. People were talking about how the NPL ratios need to improve dramatically. In Q4, the NPL slippages were the lowest and the upgradations were the highest that they saw during the entire FY18. So they kind of turned around the corner in FY18. Q1, Q2, Q3, if there were a bit of a concerns, they quelled it away in Q4, and the guidance was fairly positive as well. And look at that asset quality improvement that they have shown. This is what I was trying to say. If you look at the blue bar, that's all that I'm interested in, the blue, turquoise blue line, which is the gross NPLs for Bajaj Finance. And then look at the left axis. It shows you that for the first 3 quarters, look at the right hand side of the graph, the first 3 quarters, it had stayed elevated at 1.65%. In Q4, it slipped below the 1.5 mark to about 1.48. That's the key thing that most people have been bullish on. And Rajiv Jain, in interaction to Bloomberg Quinn, did mention that these are around the levels at which he believes the gross NPLs will stay during FY19. That's a very strong statement on such a high base. The way ahead, as I said, they're focusing on SME and commercial lending segments. While that may depress margins and ROE, but it will ensure that growth remains strong. So yes, the margins may dip a little bit, but it does ensure that the growth remains strong by this focus. There is not a single product on which Bajaj Finance has reported a negative asset quality outlook. That's a key thing. When everybody's talking about whether asset quality for even NBFCs would come off, and we've seen that happening in housing finance, which is a much more stable platform, Bajaj Finance is saying that there's no negative asset quality outlook on any of the products that it is lending towards. And the asset liability maturity profile is conservatively positioned for higher rates and tighter liquidity. Now, this is something that I took out of the Morgan Stanley report. Then I had a chat with Ira about it. What Morgan Stanley is trying to say out here is that if you just look at the first set of bars, which is the first year, the maturity pattern of the assets versus liabilities ensures that in a higher interest rate regime, the assets are maturing a lot faster than the liabilities, which means it is able to reprice these as the time goes ahead in a meaningful way. This only augurs well for a company like Bajaj Finance or for any lender, but essentially for Bajaj Finance, their asset quality, their asset liability maturity profile is a lot better, and that only augurs well for the company. I end this piece by one factor that I thought stood out from the Morgan Stanley note, and they summed it up really. Everything that is still known about Bajaj Finance, they've summed it up. They're saying that valuation is not cheap and macro is tricky, but they remain overweight on the consistent best-in-class execution. That's the key. Bajaj Finance is executing well, and that is why until there is a slip that appears in the print, people will largely remain bullish, and which is why this expensive stock continues to remain more expensive and continue to clog in new highs almost every single day. Watch out for this one. Okay. That's about stocks. Now, in the run-up to what is arguably the biggest event that the world is watching towards, the most watched sporting event is 2 days away. The FIFA World Cup 2018 kicks off on Thursday with hosts Russia taking on Saudi Arabia in Moscow. Now, every football fan will have already chosen his or her favorite team, but it didn't stop some brokerages from coming out with their prediction. We're a business channel. We don't look at other things. We look at brokerages somehow. But Agam is joining. He's a football fanatic himself in his own self-confessed terms. And let's ask him if he agrees with the brokerages. Agam, do you agree with them?
Not necessarily, but let's just start off with the projections that UBS as well as Commerce Bank have with respect to the winners of the World Cup. Let me just start off with the groups. And what we have is the ELO rating. Without complicating things too much, ELO ratings is the objective measure of team strength. And as you can see here from the charts, it's Group B, which has Spain and Portugal in it, and Group E, which has Brazil, and Group F, which has Germany in it, are the ones which are likely to succeed moving in. That said, let's take a look at UBS and the kind of projections it has with respect to the World Cup winner. And again, this is contentious. But UBS suggests that Germany is most likely to win the World Cup, and that's followed by Brazil. And I know there's going to be a big tie between Germany and Brazil, essentially on the back of their past history and record. Well, for now, it seems like we're likely to see Germany, or at least as far as UBS is concerned, Germany is likely to win with a 24% chance of winning, and that's followed by 20% chance for Brazil. And Spain, of course, is the third one here. And in terms of the next three coming in the lot, we have England. This is a surprise one coming on from the UBS list because not a lot of people bet on England going in. Of course, we also have France also in the fray, and a lot of people would argue that France should be higher up in the list. Arguably, in place of Spain at third place. That said, let's take a look at the round of 16. And well, again, as you can see, in Group A, we're most likely to see Russia and Uruguay come in. Russia, of course, has Igor Akinfe, their goalkeeper, and he's likely to produce some stoppers. And of course, we also have Luis Suarez, well, leading Uruguay. Let's just hope he doesn't bite anyone this World Cup. Moving on to Group B, we have Spain, and of course, we do have David Silva, of course, leading the games, and well, Ronaldo leading Portugal, coming fresh off the back of the UEFA Champions League title. He led them to the 13th title, and well, once again in contention for the greatest player of all times. Moving on to Group C, we're likely to see France come through, Antoine Griezmann, the most sought-after striker in Europe right now, leading the charge. And of course, we will also have Christian Eriksen in Denmark, where, well, he's coming straight off the back of a very, very successful campaign with Tottenham Hotspurs. In Group D, we are likely to see Argentina. Again, this is going to be Lionel Messi's last World Cup, and we are likely to see something special from him. And at least that's what the expectations are. Again, along with Ronaldo in contention, and also a case of a lot of arguments for the greatest player of all time. Croatia has Luka Modric, again fresh off the back of the Champions League win in Europe. In Group E, again we're keeping an eye on Brazil. Brazil has, well, just talent flowing in and out, and I know a lot of focus will be on Neymar, but its midfield as well as the defense is just as strong as their striking force. Switzerland, Granit Xhaka, well, not necessarily a great campaign, but it's still a key player for well, Switzerland going in. Let's take a look at Group F and what we can expect, and for those moving in, Germany. Of course, now I know Mesut Ozil is considered a key player, but this will again be an argument. We have the likes of Thomas Müller, Toni Kroos, even the goalkeeper Neuer out there who have the tremendous potential to push the team forward, and that's the reason why perhaps for UBS Germany it stands out. And of course Sweden, remember, no Zlatan Ibrahimovic this time around, so it's going to be all about Marcus Berg and what he can do. This may just be a little bit of disappointment because it's not really a World Cup, and with Sweden in without Zlatan Ibrahimovic. Anyways, moving on to Group G, we have England. We've had such a great season for something like Harry Kane, well over 30 goals scored in the English Premier League. And maybe this time around, we can expect England to do much better than the previous World Cup campaigns. And, well, what can I say about Belgium? It's full of stars, and all the stars have done very well. And I know the key player here will be Eden Hazard, but, you know, he's not really come off a very successful campaign for Chelsea this time around. But as a whole, it's all about clicking, and that's going to be crucial for Belgium. And, of course, moving on to the final group, Group H, we have Senegal, Sadio Mane, and Evan's going to keep an eye on this one. He's had a great season. And Colombia, well, we have James Rodriguez. So these are some of those teams which are expected to move into the round of 16, and some crucial players which are likely to influence, well, the World Cup. Again, when it comes to Commerzbank, they are also rating Germany higher than Brazil at around 18% probability for Germany to win the World Cup, just in about a 13%. This is, again, going to be a case for a lot of argument. And Spain, again, coming third. So a lot, at least UBS and Commerzbank are keeping something like France and Argentina behind. Argentina makes it in the Commerzbank list. It does not make it in the UBS Bank's list. So we're going to have to wait and watch for what that means. Again, as I mentioned earlier, it's going to be a very, very important World Cup for Lionel Messi, especially given the fact that it's his last one. So we'll be watching out for these. And these, of course, don't forget, just projections from UBS and Commerzbank. We're going to have plenty more coming up. But that's what we have in terms of the World Cup this time. It's Germany for both these broking houses.
Yeah, and probably Germany for a lot of people. Now, just a couple of questions, Agam. One is, France so low would also be a factor of how the recent performance has been, right? A lot of stars present there, but the recent run-up to the World Cup fairly patchy for France.
Yeah, so it's more about how they gel as a team. Again, France is full of stars, and it's not necessary that a lot of these guys have had a great campaign and they may not be in so much form. And I think if you consider the economic analysis that these guys have carried out, they're also taking into consideration how the performance has been for a lot of these players for France. So first we have to remember that there are a lot of players who are new. Key players like Pogba have not had such a great season, and only the striking force is out there that will include something like Fekir or, for that matter, Antoine Griezmann, as I've mentioned.
Yeah, so let's see. Griezmann would be one key thing. Just that the run-up has not been that great. So let's see what happens there, and let's see what happens to Spain. Somehow, I'm placing my bets on Spain. What about you, Agam?
Well, I would place my bets on Italy, but they're not playing the World Cup.
Unfortunately, yeah, I know my favorite team. Somehow they've missed this time around. It's just inseparable, right? But they're not there this time around.
Yeah.
Anyways, let's wait and watch. Thanks for that, Agam, and we'll of course keep on coming back to you tomorrow and day after as well with updates on this. This is probably the biggest thing that everybody's watching out for. We'll keep it alive on Bloomberg Quint and on First Word almost every single day. But that's all that we have on First Word for the day today. Lots more lined up on the show though. We discuss markets and macros with Harsha Upadhyaya of Kotak KMAMC. Take a look at the growth prospects for Dish TV with Managing Director Jawahar Lal Goel, and discuss Sobha's record sales in FY18 and its expansion plans with Managing Director JC Sharma. After the break, focus towards the day's trade.
Welcome back. You're watching Indian Open. Let's see how the Asian markets are faring at this point in time. Well, marginally in the green for the Shanghai as well as the Hang Seng. Nikkei trading higher by as much as 0.3%. What does it mean for the SGX Nifty? Well, that's marginally in the red right now, just shy of the 10,800 mark currently. But with that, let's take a look at the kind of trends that the derivatives segment is throwing up and what we can expect based on those in terms of opening today. We have Navneet Saluja joining us to give us an idea. Navneet, good morning.
Hey Agam, good morning. Well, we're staring at a flat start at least, and if you look at yesterday's trading session, we ended off the day's high, which was not a great sign. So if you look at the futures, they continue to close at a discount, but let me tell you that this discount has fallen from the levels of 18, but nevertheless, there were some fresh positions taken on Nifty futures because the open interest was up nearly 4%. Well, looking at Bank Nifty, the futures did close at a premium of almost 23 points, but no major build-up was seen when it came to the open interest. That was up only 1.5%. Pull up the volatility index, that definitely went higher once you saw the index touching those levels of 10,850. So India VIX finally closing with gains of nearly 4% in yesterday's session. PCR went up. There was a lot of put activity which was seen in the system, and precisely that's the reason why Nifty PCR went to level of 1.53. Bank Nifty PCR, which still remains below the mark of 1, but that went up to levels of about 0.89. Let's tell you which are the strike which contributed to rising PCR yesterday. 10,700 and the 10,800 put strikes were the one where maximum amount of open interest was added, and it was clearly evident that there was some bit of put writing which was taking place in the system. Unwinding took place for 11,000 call strike, which is sitting with maximum open interest. So the range is actually still the same for June series. It is between 10,600 to about 11,000. What did the institutions do yesterday? Well, there was some bit of long positions taken definitely on the index futures. Nearly 9,500 contracts were added. Whereas if you look at the index options too, there were contracts added on the call long side, and even the put short, nearly 10,000 contracts were added here. Stock futures, what to keep an eye on in today's session. Watch out for RBL. Fresh long positions were seen for this one as the stock ended higher in yesterday's trade. The other stocks I'd be watching out will be Balrampur Chini, where short covering was seen, and also something like Container Corp, which was down yesterday.
Okay, we'll watch out for some of those names. Navneet, thanks a lot. Just one quick question. Yesterday, quite unlike Friday, the options activity, at least on the indices and from the FI side, seemed to be a bit muted, and fair bit of short positions on select consumer names as well in trade yesterday. That's right, Neeraj. The consumer stocks saw some bit of profit booking coming by, and let's not forget they've been rising and they've been outperforming the markets like we've seen the ID pack in the past. So yesterday was the session where I wouldn't call it major addition of short position, but at least that trend started to kick in. Well, let's wait and watch. Thanks, Navneet, for putting us or giving us those updates as well. Let's get in a fundamental voice on that note, and then we'll, of course, get in a derivative voice a bit later on in the show as well. But Mayuresh Joshi, fund manager at Angel Broking, joins us right now on the show. Mayuresh, always a pleasure having you. Many thanks for joining in today. yesterday the world markets were doing reasonably okay, but we seem to have entered a bout of profit booking, if you will, after 3 or 4 days of a rally. How do you characterize yesterday's trade, and do you reckon that because of the one event today and 2 other large global events later on Wednesday and Friday, we might have muted trades throughout this week?
Good morning, Neeraj. So that's a possibility, I think. What the markets are really wanting to know is the Fed statements. So what actually comes out, even if one assumes a 25 bips hike happening in the Fed meet, I think the statements and the commentary thereof is going to be the immediate focal point for the market at this point of time. Having said that, I think the kind of earnings growth that our own markets have exhibited and the earnings cuts that we probably still seen coming through, again, I think there is no confidence in terms of earnings recovery at a fast pace. So even if one assumes a marginal recovery to start seeping through in Q1, Q2, you are still embedded with the fact that inflationary pressures still remain extremely high, and that's the entire justification of RBI probably hiking with the 25 bips rate hike as well. So I think macroeconomic conditions in this sense also look a little bit tight. What you're probably going to see in terms of better monsoons might have some respite in terms of food inflation cooling off. But then you've obviously got the political overhang as well. So there are a lot of sum of moving parts for our own economy. I think the bond yields to a certain extent are allaying those fears in the yield movement that we've probably seen. And again, I think the global factors at play. So again, US markets probably seemingly there on a high track. What probably comes through their own earnings season, what probably happens with central bank actions in the Eurozone are extremely critical as well. So again, in terms of valuations for our own market, I think a tad bit on the higher side considering the earnings trajectory that we are on at this point of time. So again, I think it's going to be a stock-specific approach. But what you've also seen, Neeraj, in terms of the mid-cap mayhem and what probably comes through in terms of earnings specifically towards the larger and broader universe, I think it's a better and justified strategy of probably sticking to qualitative large and mid-cap names. So I think it's going to be a stock-specific approach in my opinion. I think these bouts of profit booking might continue, not just for this week, but for some more time to come.
Mayuresh, good morning. This is Agam. You just spoke about being stock specific. Over the last few days, there has been a very sharp divergence within the broader market. So while certain mid-cap and small-cap companies are rising sharply, in the opposite direction, we have few others which are declining sharply. What do you make of these moves, and what are your observations here?
Morning, Agam. So no, clearly, as I mentioned earlier, the entire universe had broadly moved over the past few months. What you probably saw in terms of correction and all the news surrounding auditor resignations and what you probably seen within the broader universe, there was obviously fright with the ASM mechanism coming through. And again, what you probably seen in terms of mutual fund activities, in terms of consolidation of their schemes and portfolios, you probably did see upheaval in few of the stocks within the broader universe. Now, within this universe as well, Argam, I think the qualitative names which have good moats surrounding them, both in terms of brands that they probably have, in terms of the earnings trajectory that they've posted in the past, giving confidence and reposing that confidence in terms of that earnings trajectory still getting maintained over the next few quarters. And again, their niche product stroke service pipeline, if they possess that, I think those are going to be standout features in terms of differentiating probably the men from the boys. So what you've probably seen in terms of moves being divergent, I think that kind of action can very well continue. And as I just pointed out, I think the earnings trajectory is something that is going to be extremely critical. So it's not just this June quarter numbers and the quarter after that. I think that's going to be extremely important for the broader universe. Companies which can post a good set of numbers where the managements can give good visibility, I think my own sense is that these companies will keep on outperforming. So you can't paint the broader universe with the same brush. I think there are still qualitative names within the mid-cap universe that, in my opinion, can really do well on all these premises.
Right, Mayuresh, hold that thought. Let's take a look at all the stocks which will be in focus in today's day of trade on the back of stocks and news. And we also have a few brokerage reports where we have some coverage when it comes to certain sectors. We have a research team joining us. Thanks, guys, for joining us. Shraddha, let's start off with the stocks and news.
First on the list is Usha Martin. Now they will explore the sale of their steel business. This is mainly to deleverage their balance sheet. So the board has formed a committee which will look to appoint investment bankers and advisors to help evaluate this proposal. It's only at the exploratory stage. Then you have Welspun Corporation, which has received yet another order. This is after the order that was received yesterday in the US markets as well. So yesterday, with yesterday's order win, the company said that the order book stands at about 11,000 crores, and today they've said that it stands at 11,400 crores, so probably a 400 crore order win. KDTL Limited, they will raise the FPI investment limit to 49%, and additionally they're looking to raise about 30 crores via equity. Watch out for that name. Strides Sassoon has received the approval from the US FDA for generic Tamiflu tablets, the market for which is about $725 million, so a reasonably sized drug as far as Strides is concerned, because they don't have a large presence in US. Hotel Leela Venture, they will issue 125 crore equity shares to JM Financial ARC in one or more tranches. This is on account of conversion of debt. The price has not yet been determined. TCM Shriram, they will mull share buyback on 18th of June. And finally, in insider trades, you have Lincoln Pharma promoter who acquired 50,000 shares on 8th of June. So he has upped the stake by about 0.25%. So some of the names to watch.
Right. And Nikki, we have a Goldman Sachs note on steel.
Somewhat bullish note, I would say. They've spoken about how spreads have remained resilient in the face of domestic coking coal hike that we've seen in coking coal prices, along with your domestic iron ore prices. Now spreads have remained firmly above the quarterly average that we've seen, and however they expect it to cool down from the current levels. This is what the note says. It also says about the strong China export despite the high trade protectionist measures in that region. Besides that, they've also spoken about the depleting inventory that we're seeing, which would in turn lead to lower spreads coming in for the regional players. It has maintained a buy rating on JSW Steel, however has revised the target price upwards, given that it sees an upside risk to Bloomberg consensus estimate. It says that there has been a sharp contraction in spreads. Also, it has spoken about Tata Steel, which is not rated by Goldman Sachs, but it said that it has tweaked the EPS estimate given the kind to factor in the current spread estimates.
Right, thanks for that, guys. Mayuresh, I'm going to take forward the steel sector with you. How are you reading cues on this one now, and how do some of these stocks stack up in comparison to its other peers?
So a large element, Arkham, in terms of domestic demand, specifically for steel makers, seems to be extremely strong and buoyant even at this point of time. What you probably saw in terms of raw material prices, both coking coal and iron ore spiking up, cooling off a tad bit, that did cause some concerns in Q3, Q4 with the EBITDA per ton actually coming down a tad bit. But probably I think stabilization in terms of the reported operating numbers on the EBITDA front should probably be the base case scenario. In terms of volume growth, again, the kind of expansion programs that a lot of these steel companies have embarked upon, whether it be Tata Steel expanding their operations domestically or JSW Steel, you're probably going to look at reasonable volumes going ahead with decent realizations. What you're probably looking at in terms of the leverage getting played out on their balance sheet is going to be supported by strong demand that can very well continue for the domestic side of their business. For the overseas business, specifically for companies like Tata Steel, I think the demand-supply dynamics are far more volatile at this point of time. What you've also been hearing for Tata Steel and ThyssenKrupp, I think really what emanates out of that can also have a bearing on that stock. What happens with the Southeast Asian prices, specifically ferroalloy, is going to be extremely critical as well. But for steel companies specifically operating out of India, I think the demand dynamics should hold up. What you're also probably looking at in terms of the spreads between billets and sponge iron at this point of time, the HRC pricing probably has got elevated as well, but not to that extent to what we probably seen the billet prices go up. So any companies which are probably into the long product segment is going to be a beneficiary in terms of realization holding up and stacking up really well over the next few quarters. Again, export demand and domestic demand both should hold up, and that should abet their earnings growth as well. So again, I think steel companies should probably do well. JSW Steel continues to be a hold. An outside bet in terms of a short to medium term move, specifically in the billet scenario, can be anything like a Jindal Steel and Power.
Interesting. Mayuresh, we were talking about NBFCs, and there has been a chalk and cheese behavior between the 3 or 4 or 5 brokerage names, like Motilal, because of that housing finance fiasco, is now trading at about 900 or lower than that, whereas IIFL yesterday was up another 5%. Edelweiss has been rock solid at about 320. So the pain is clearly evident in the Motilal Oswal stock. From here on, if somebody wants to invest, where is the risk reward more favorable? Or maybe an MK or a JM Financial, but I've chosen these 3.
So very bit difficult to comment, Neeraj, on these stocks. But I think within the NBFC or the broader universe, what we probably really like, even at this point of time, can be companies which are very well capitalized, where I think the fear in terms of yields moving up and the inherent fear in terms of their borrowing costs moving sharply ahead and not able to pass through the kind of rise that they'll probably see on their books and able to maintain their spreads and NIMs are going to be extremely critical. Having said that, my own sense is stocks like an L&T Finance Holdings, which have reported excellent set of numbers, and where our own thesis in terms of loan growth and the diversification of their book, though still heavily skewed toward the wholesale part of their business, I think those sum of parts should start coming through with decent growth seen both in rural financing, housing finance, as well as the wholesale finance business, where you're actually seeing down the write down or the rundown in terms of their assets, probably looking at fee income growing at a pace of 40-50% going ahead as well. Asset quality pressures seemingly coming off. The QIP that they've done holds their capital adequacy in good stead. So I think L&T Finance is something that we'll continue to pursue and like. What we're also liking within the broader universe can be a Chola Finance. Yes, the stock has run up significantly. Maybe if you do a comparison check, the price to book still remains on elevated levels. But the return on equity still remains best in class. What we're probably seeing in terms of capitalization, as our thesis puts it, still remains one of the best within the rural financing themes. And again, asset quality pressure, specifically after moving to the 90-day window, still remains extremely strong compared to its peers. So though I think a little bit expensive in terms of price to book multiples, we still see tremendous value over the next 2 to 3 years in this stock.
Mayuresh, it's interesting that you spoke about L&T Finance Holding, because that was also one of the stocks which came up on the Bloomberg consensus most preferred NBFCs. But there were also those such as Capital First, as well as 2 companies from the public sector space, that is PNB Housing Finance as well as Canfin Homes, which were also most preferred. But this, of course, is according to the Bloomberg consensus. What's your take on these housing finance companies, and perhaps if you are willing to comment on some of these public sector housing finance companies as well?
No, so Arkham, housing finance as a space has done exceedingly well. What you're probably talking about in terms of affordable housing and the government thrust towards that, both in terms of urban affordable housing as well as rural affordable housing, there is significant scope in terms of what can get delivered in these spaces. The second element in terms of the generally cost of borrowing going up, I think a lot of these housing finance companies also have a diversified cost of borrowing. And though I think the trend in terms of bank borrowings still remain heavily skewed on their books, I think the kind of increase that you've probably seen because of yields and the corresponding hike that they'll probably need to do in terms of pass-throughs, my own expectations is that it can get absorbed with not just this 25 bips hike and the bond yield moment that you've seen. So I think it should not be having a detrimental impact in terms of their advances book being hit with these pass-throughs. But having said that, I think the kind of margins and spreads that these companies will enjoy, I think that will still get maintained because of the pass-through impact. So a large element in terms of housing finance companies, Diwan Housing is something that we've liked in the past. Anybody holding that can continue holding, both in terms of they're expecting to hold NIMs around the 3% mark. Asset quality pressures not expected to get elevated from the current level that they're probably looking, which basically means that the credit costs should probably be contained, leading to a significant improvement, specifically in ROEs. Within the PSU pack, my own sense is that companies like PNB Housing Finance are looking extremely strong, both in terms of the advances growth that they can post. But what we're probably liking at this point of time can be a GIC Housing Finance, where our own expectations is a 23 to 24% advances growth over the next few quarters. The reported asset quality numbers are on the higher side. GNPA is 2.4%, net NPA is skewed on the higher levels as well. But they have not taken any write-offs. So my own sense is that as they start dwindling down or writing down their asset quality pressures on their book over the next few quarters, their bank borrowings have come significantly lower, which means that the kind of impact that one expects in terms of their borrowing costs going up should be far lower, and their ability to maintain NIMs at 3.7, 3.9% and trading at 1.5 times price to adjusted book. I think it makes a compelling case if one has a 2.5 year view.
Okay, 8:45. Mayuresh, stay on, so much more to talk about. Let's get in our technical experts on board to try and figure out which way trade could shape up. Hadrien Mendonca, Senior Technical Analyst at IIFL, joins us on the show, as does Thakkar, Assistant Vice President for Equity Research at Anand Rathi. Well, good having both of you. Thanks so much for joining in. Hadrien, your bullishness last week has held you in good stead, I'm sure. But what did you make of trade yesterday and the slight bit of a pullback that we saw in the second half? And how does that augur for the rest of the week?
Yeah, so the pullback that we've seen yesterday is actually, slightly showing signs of an early reversal. Now, if you see the overall picture, we continue to trade in this symmetrical triangle pattern that I spoke in the previous week as well. But if you have noticed, the 10,820, 850 zone is acting as a very important resistance zone. That shows a fractal nature of the current market, adhering to each and every resistance that is coming in line. That's why we saw some profit booking around those 820, 850 levels as well. So I think going forward, there are two important points, that is very important to be taken out by the Nifty. So the first is 10,820, 850 zone. Second is 10,930 levels. So until and unless we don't see a convincing close above both these important levels that I just spoke about, I think, we might see the momentum just going sideways, or, might also be stalling. Because every time the Nifty is trying to break out of this symmetrical triangle, there is a profit booking coming in. So we are seeing a little bit of pressure around those levels. So I think, as I said, 820, 850 zone has to be taken out convincingly before this momentum has to go forward.
Okay, let's welcome in Thakkar as well from Anand Rathi. Jay, good morning. How are you viewing trade on the benchmark indices right now?
Hi, good morning, everyone. Well, index has been trading within this range of broadly, 10,930 to 10,550 now, which is the recent swing low that's been placed. So approximately there's a range of almost 400 points, and now since Nifty has reversed from the lower end of the range, we are expecting it to climb towards the upper end of the range, or somewhat near to that range. So 10,870 is going to be a target for the short term. 10,745 is the reversal for the short term. Now I believe that, till the higher tops and higher bottom pattern continues on the daily charts, the probability of this move providing a breakout on the upside is quite high, being also a buy crossover on the daily charts on these momentum indicators, as well as the weekly momentum indicators are well into the buy mode. So looking at the momentum indicators, I think that the probability of this breakout on the upside is quite high. If not now, then it might again reverse from the higher end of this range, and then again gets pulled back toward the lower end of the range, and finally when it reaches to the apex of the consolidation, it will provide a breakout. But I think more or less it's either sideways to positive momentum, because we have been seeing that stock specific, we have been seeing a good move coming in, and recently we have seen the Nifty Pharma Index getting bottomed out. So I think that there are a few sectors which are definitely going to provide the support to the index. It's mainly now to look forward that whether Bank Nifty is going to provide a breakout or not, because we had seen a sharp cut coming out there, and Nifty has almost reached again near to its upper end of the range, but then Bank Nifty is still struggling, wherein it was leading earlier in this entire rally. So I think on the upside, Bank Nifty really needs to take off those resistance levels of 26,700, 26,900 zone in order to get a big breakout on the upside. Else that can continue to add pressure to the index.
Okay. Gentlemen, stay on before we take in your stock-specific recommendations. It's 8:50, that time of the show when we get a special segment, Bloomberg Edge. Jayesh Kilani Johnson to tell us about a pattern that the terminal has thrown up. And Jayesh, what's the stock on the radar today?
Morning, Neeraj. The stock is Grasim, and there's good reason for that as well, because it's down about 10% in the year so far, and with yesterday's close or yesterday's price movement, a bullish engulfing pattern has been formed on the chart of Grasim. Let's first have a look at what the bullish engulfing is and what conditions you have to look for. It's a two-candle chart pattern that you have to watch out for. So essentially, it's a bearish candle which has to be followed by a bullish candle. So first red and then green is what you have to watch out for. The second candle should be completely bigger than the first candle that you have. So the green has to be bigger than the red essentially, and a few conditions other than that. The longer the second body of the bullish candle, the better it is. And once you have all of these parameters satisfied, do not look for any further confirmation. It is called as a bullish engulfing. That's the chart of Grasim. So what we had seen actually in the last 3 months, the stock had been range bound. You can see from March to about mid-May, it had been trading in the range of about 1060 to 1100. Post that, it actually broke down, and the range then shifted from 1020 to 1060. With yesterday's close, what has happened is you can see that this green body that is completely engulfing the previous red one, which makes it a bullish engulfing. And also the numbers 1, 2, 3, what you see on the screen, those are candle session numbers, and we know by theory that candle sessions normally reverse at about 9, 10 or 13. So if this has to go to about 9 sessions, there could be 6 consecutive days that you could see gains for Grasim come about.
And Jayesh, what would you suggest when it comes to backtesting and probabilities of success of this one?
So Agam, backtesting shows that the average profit over the next 10 days was about 11% in the past.
Thanks a lot for that, Jayesh. We'll watch out for Grasim as well. Yesterday, Grasim and Ultratech, both of them did reasonably okay for themselves in trade. Let's ask our experts about, well, we'll talk about Grasim as well, but first, let me ask them about the stock recommendations that they are making in the session. And Jay Thakkar, good having you back after a while. What are the stocks that you're recommending today?
Well, as I said that, I think that there's a good bottom in place in pharma, and I've been anticipating, and I've in fact been been recommending on your other shows on your channel. But then I think that from here to there is much more steam left on the upside, and I think Lupin has clearly provided a breakout from a falling wedge pattern. The stock has clearly formed a double bottom pattern if you see on the weekly charts, and especially I would say on the weekly chart, this stock has been providing the positive divergence, showing the positive divergence since a year. I mean, since July 2017 till now. I mean, it's a big medium-term call. However, for the short-term as well, there is a good trading opportunity because we saw some correction happening in it from the higher levels in yesterday's trading session, again providing an opportunity to buy on dips. So Lupin is a buy targeting around 835 in the short term with a stop loss of 795. NCC, the recent rise which we had seen, it was a sharp rise, and that was clearly a 5-wave. That is an impulsive move on the daily charts, post which we saw the stock correcting in 3-4 trading sessions by almost 78.6% of its previous rise. And now, since past couple of trading sessions, we have been seeing this stock again forming higher tops, higher bottom on the daily hourly charts, and the indicators are back into the buy mode after that sell-off of 3-4 trading sessions on the daily charts. In fact, I would say that indicators have reversed from the zero reference line, which is quite positive. So I think that NCC2 is a good buying opportunity at the current levels. One can target 121.50 with a stop loss of 108.
Okay, and Hadrien, what are your strategies for the day?
Yeah, so both one is long and the second is short. So the one that we are bullish on is Z Entertainment. We have seen a very, very good price and a volume breakout on the daily charts, and it has also been accompanied with positive crossovers that we have seen in the other oscillators, also indicating that this momentum will continue forward. So I think one can consider going long in Z Entertainment for a target of 585 and place a stop loss at 558. The second stock that we are bearish on is Concor. So Concor has actually formed a bearish engulfing pattern, and this bearish engulfing pattern has not only completely engulfed its previous day's candle, but also its previous 3 days candles. That is implicating that this bearish engulfing is pretty strong, and we can see further selling pressure going forward. So one can consider short selling Concord June futures and play for a target of 1286 and place a stop loss at 1335.
Right. Well, Mayuresh, after the recent spate of good news coming in for the pharmaceutical sector, how are you placing your bets in this one? And as a sector, do you think it's turned a corner?
No, so Argam, in terms of the earnings downgrades over the past few quarters, a lot got gestated in the price with the fall that we've probably seen. Now, with the spate of FDA approvals that are probably come through, both in terms of voluntary action initiated, as you've recently seen for the Halol facility, there is visibility and the managements have put that forth. So if you look at Sun Pharma's con call, they are optimistic of a double-digit growth happening in the second half of this year. The other companies also are a little bit more optimistic as and when their plants get cleared in terms of the pipeline that they possess. So I think Sun Pharma, with a huge amount of the ANDA pipeline, is specialty listed that, which also includes stuff like Doxil, you've got Bromside, you've got Yosan. So I think there are multiple specialty products in the pipeline, which once cleared, I think can do exceedingly well in terms of both the revenue size that they can generate from the exclusivity period if they probably get that chance. And again, expectations of margins probably holding up because they are niche products. Take the case of Lupin, for example. I think they've got a very strong NDA pipeline with 36 first to files. So as and when I think these pipeline start getting monetized over the next few quarters, the pricing pressures apparently shall start coming off. What we've probably seen in terms of R&D expenses still being elevated on their balance sheets, the compliance and the remediation costs still remaining high, probably have eaten into earnings. So yes, I think I had been optimistic on Lupin from the large cap names.
Okay.
Sun was a hold, but the moment has been large. So I think Ipca Labs is something that will still continue to be a favorite within the mid-cap pharma universe.
Where is the smaller names like Alembic Pharma? Do you track that one? Had a big day yesterday.
Unfortunately, I don't do that, but I think within the universe, as I said, I think Ipca looks pretty interesting for the domestic formulations holding up, the anti-malarial tenders actually holding up, and any approvals even for their US FDA affected plants, because the kind of compliance efforts that the management has taken for all their 3 affected plants, if they bear any kind of a fruition going forward, I think you are going to see a surprise element in terms of earnings estimates being probably revised on the higher side. We did like specific few names within the larger universe like an Atco and an Alchem. But again, I think one really needs to take a stock-specific view within the mid-cap universe.
Sure. Hadrien, what about AstraZeneca or Alembic? Do you track them on the charts? Both of the stocks were very active yesterday.
Yeah, definitely they were very active, but I think we have not spoken about this one particular stock that has been an outperformer throughout the pharma sell-off that we saw, and I think we are missing out on Pfizer. The stock has been a clear outperformer and we have seen a very, very huge multi-year breakout on the weekly charts as well as the monthly charts. So I think one should not, miss out on a Pfizer because it was an outperformer during the bad times, and I think when the time is going to come back for the pharma industry, I think Pfizer is going to be one of the biggest outperformers. So not a trading call, but a delivery based 6 to 8 month strategy. Investors can consider Pfizer as a very safe bet going forward. Yeah, and as far as Alembic is concerned, I think it was pretty volatile yesterday after hitting that high of.
Hadrien, just give us a minute. Let's just address the pre-open rates and we'll come back to you. When it comes to the Nifty and the Sensex currently, we're looking at mixed opens. So the Nifty trending downwards and the Sensex on the other hand, in the green. Actually, the Nifty's just changed path and now it's marginally higher. But of course, these are pre-open rates. We are going to wait for these rates to settle down. Let's take stock of Tata Motors right now because we understand that the JLR is planning to move some of its activities from Solihull down to Slovakia as part of its restructuring. And on account of that, we're seeing an uptick of as much as 1% right now. It's been fairly active. Yesterday's big gain of the day, Bharti Airtel, let's see how that's faring in today's day of trade. Are we expecting more advances? Yes, it's up as much as 0.6%. And Bajaj Finance, which continues to remain one of the top Nifty gainers, it's likely to see an uptick of another 1% in today's day of trade. We also have Grasim, which is in focus, which was also up and about, advancing by as much much as 2% yesterday. It's likely to see a green opening today's day of trade. And on the losing end, we did have some weakness in Tata Steel, but this morning a Goldman Sachs note suggests some positivity coming through. Of course, Tata Steel was weaker because of questions raised on its deal with ThyssenKrupp as well. And let's pull up something like an HCL Technologies, which was also trending downwards by as much as 2%. And one more stock from the information technology sector is Infosys. It continues to be in focus because it continues to rise slowly but steadily, and that's well above the mark of 12,666 currently as per pre-open rates. And we're going to be keeping an eye on some of these index stocks going in today's day of trade.
Well, interesting. Bring up first the rupee and the bond yields, and let's just see what they are up to before we move on to some other stocks. The bond yields were in or around, okay, the currency first, and no great moves, 67.44, around the levels at which we opened as well in trade yesterday, not just closed. So no great moves there. The bond yields should come up on your screen, 7.97 again, steady at those levels, so no big moves. What's happening at the broader end of the spectrum? That's what I just want to point out. JCorp, after having a big move of 18% yesterday, up on a okay, now it's cooled off a little bit. It was up about 14-15%, still now up about 2 or 3%, but was showing an unnatural rate any which ways. Hathway Cables the last couple of days has done reasonably okay. So that continues to rise and shine. Kaplan Point has some gains to itself. Whirlpool has some gains to itself, so good going there. What's losing out? I believe the usual would be losing out. Just bring up those stocks. Actually, bring up 1% beverages. That stock is down 4%, not 5%. Well, let's wait and watch. Quality, unfortunately, is down. Rain Industries is correcting a bit as well. So let's wait and watch what happens to those stocks. Last but not the least, first Welspun Corp, they've gotten an order. Let's see if that stock is reacting again after the 4% up move in trade yesterday. Is Welspun Corp up about? Yep, about 1.5%. So good going there. And AstraZeneca and Alembic Pharma, two stocks which went up in trade yesterday. Both of them doing reasonably okay for themselves. And Hadrien Mendonca was just making that point before we had to go on the pre-open. So Hadrien, you were making a point firstly about Pfizer, which you completed, and you were going on to make the other point in the pharma space.
Yeah, so I was coming on to the Alembic part that you asked for. So we've seen a very good retracement of the breakout that we saw 6 months back. So I think the whole retracement is almost done, and I think it's time that Alembic resumes its upward journey. So I think if anybody is considering Alembic as a stock in their portfolio, I think one should consider Alembic at these levels because it has corrected sharply, and you are getting it again at the breakout zones. So I think good time to enter Alembic at these levels.
Okay. Let's get in Somit Sarkar now, who joins in with the big brokerage calls of the day. Somit, good morning. What are brokerages saying?
Good morning, Neeraj. On the big brokerage calls for the day, first we have is HSBC on GAIL India. Now, the brokerage has maintained its hold rating on the stock but has raised the target price to 355 from 325. Now, according to the brokerage, improving transmission profitability, lower US LNG contract risk and rising petchem volumes are the positive when it comes to GAIL India. Now, the brokerage is expecting the capacity utilization levels of both the transmission business and the petchem business to rise going forward. Along with this, higher oil prices and relatively subdued US gas prices is reducing the US LNG contract risk on the company. Going forward, the next trigger for the company would be the PNGRB's decision on the unified tariff plans. However, the progress on this front is a bit slow according to the brokerage. Lastly, the brokerage has raised its FY19 and FY20 earnings estimate for GAIL India by 8% to factor in higher petchem realization, higher LPG volumes and higher gas trading profits. Second we have is Nomura on Dr. Reddy's. Now, the brokerage has maintained its hold rating on the stock, buy rating on the stock with a target price of 2,704 rupees. Now, according to the brokerage, Suboxone launch is expected to be in the near term, as an early launch can act as a positive catalyst for the company according to the brokerage. Now, the brokerage is expecting the competitive intensity to be low initially, which could rise over the time. Now, the brokerage is expecting the competition to be limited over the next 3 years post the launch. Nomura is expecting the EPS impact because of this launch of this product could be close to 62.5 rupees per share with no additional competition. However, the brokerage notifies that the as competition intensifies, the EPS impact could be as low as 2.5 rupees per share going forward.
Somit, thanks for that. Thanks for getting us those details. We'll be watching out for some of these broking calls and what impact they can have on stocks today. But Jay, I'm going to take up Infosys up with you. As I just mentioned, it's been on a steady rise over the past few weeks, and it's trading at, well, at least 52-week highs, if not lifetime highs, currently at 1266. What's your call on this one, and can we expect more strength to come through for this one?
Absolutely, we are quite bullish on Infosys. We have been bullish on IT since December 2017, and continuously I think that Infosys is forming high tops and high bottom, although slowly, not as compared to, you cannot compare it to the move we had seen in TCS or the Mindtree or Tech Mahindra, but then this stock too is forming good high tops, high bottom. It consolidates, again breaks out, and again consolidates, and again breaks out. Now recently we saw this stock, it was consolidating within a range of around say 1190, 1200 on the low side to 1240. Now that's a 40 points range which got broken out on the upside to 1280 was the immediate target. However, we would say that further too, we can see this stock inching towards the levels of almost 1330, which is almost the upper end of this rising channels. And I would say that as a disclaimer, we already have a buy call on Infosys. In fact, we have a bullish strategy out there, a bull call spread, wherein we have recommended to buy 1240 call options and sell 1280 call options.
Interesting. Okay, 8 minutes just about coming to a close. So the pre-open rates just about settling down, and what we have is the OMCs looking like starting off on a decent note. So HPBP look like starting off on a fairly decent note, not too many losers, which is always a good sign from a bull's perspective, and likely to have a start of about 0.25% on the Nifty. The Sensex flattish. Let's see what happens to the Nifty Bank. Bajaj Finserv looks like adding another 1% to itself. We talked about NBFCs by and large. Mayuresh, Joshi, Bajaj Finserv, what's the call on this one?
Also steady growth, Neeraj. I think if you look at both these Bajaj twins, both Bajaj Finance and Bajaj Finserv, what they've actually delivered in terms of both top line, EBITDA and bottom line growth, I think it has been stellar over the past few years. Even if one conservatively downgrades to a tad bit their expectations in terms of all these growths actually coming down, you're still looking at a very strong earnings momentum that they can post. Again, the confidence in terms of all their business segments probably doing well is again reposed by the numbers that they are posting. So a large element in terms of valuations staying on the higher side for these companies, if they're able to deliver on the growth aspect I've done in the past, and I see no doubt why they shouldn't in the future as well. I think investors holding on the stock should continue holding, not just Bajaj Finserv as I said, but even Bajaj Finance.
Okay. So that's Bajaj Finserv and Bajaj Finance. Wonder if there's a trade here, Jay Thakkar. Bajaj Finance continues to rock and roll. Finserv too went up yesterday. If you were long in both of these names, would you stay long?
I would say that we already booked profits out of Bajaj Finance. We were bullish out there, and yes, we have seen this stock in fact providing a very clear breakout. But then in the short term, however, I would say that it has reached to that overbought territory. But on the flip side, I would say that Bajaj Finance still looks good. It's better, I would say, compared to Bajaj Finance. Finserv has not shown that kind of a move on the upside, and it has not reached to the overbought territory. So it might happen that Bajaj Finance just consolidates or move with quite a lot of noise on the upside, that is, an up and down move. But then Bajaj Finserv can still see good amount of up move from current levels. So I would say that, right now there is a good opportunity as far as the risk reward is concerned in Bajaj Finserv. And I will just give you the levels out there as far as Bajaj Finserv is concerned. On the upside, I think, in the short term, we can see the levels of 62.20. 62.50 as well. On the lower side, this stock has a very good support in the near term at around the levels of the recent short-term moving averages around 5900 zone. So I think till those lows are not broken, we can see levels above 6200 on Bajaj Finserv.
Okay, minutes away from market open. Let's tell you all that you need to know in trade today. Those are the 6 most important things. The board of Fortis Healthcare has deferred their 4th quarter results to 25th of June, while it has also extended the deadline to submit bids to June 28th.
And Tata Motors will be in focus as Jaguar Land Rover moves production of the Discovery model from its Solihull factory in the UK to Slovakia as part of the company's restructuring exercise.
Amongst companies meeting investors and analysts today include Voltas, Blue Star and BSE.
Brokerage firm Goldman Sachs is bullish on the steel sector. It believes that the spreads will remain resilient despite cost increase.
And good news for Strides Sashun as the company gets US FDA approval for generic Tamiflu capsules in the US market. The stock's likely to start off 5% higher.
And Usha Martin mulls sale of the steel business to deleverage its balance sheet.
And that stock too, starting off with a bang, about 10% higher in trade. Mayuresh, a couple of small names. I don't know if you track them. We've been talking too much of pharma today, but let me throw in a Strides Sashun there. And if not, I don't know if you track Usha Martin amongst the small-sized metal names.
Don't do that, Neeraj. But what you probably like within this broader universe is GMM Pfaudler. So what the company has delivered in Q4, I think it was quite extraordinary in terms of their product mix, the cost optimization. And again, going forward, if you look at their glass-lined equipment business, where the EBIT margins are exceedingly high, I think the utilization levels at 80%, market share of 55%. They've also got the gas furnace part working for them. So there is significant cost savings from the electrical furnace that they were operating out of. Their pharma business has actually come down to significant lower levels. With the pharma city coming outside Hyderabad, I think more orders can flow through on that aspect as well. Heavy engineering, again, I think the EBIT margin is reasonably higher than the proprietary products. So good order flows expected on that front. The cash and liquid investments around 116 odd crores. They need to do a capex of around 10 to 12 odd crores for the coming fiscal. So our own expectations, 18% top line, 20% bottom line growth, better than what the management probably expects. So I think this is one good value play that one can look at within the broader universe.
Okay. As the pre-open day, so GMM Pfaudler, do watch out for that one. Let me get a chart check here. It's been very, very volatile. Strides Sashun the last few days, weeks, etc. Hadrien, Mendonca, Strides Sashun on the charts. Or is it a difficult one to call?
Volatility is too much in the stock in the past 2 days. Yeah, it's a difficult one, but nonetheless, we are seeing a double bottom kind of a formation. But it's very important that it holds on to. The double bottom low of 333 or 330, if I may say, should hold on to for any kind of upside from here on. If the 330 levels is broken, I think it's going further lower from here on. So 330 something to watch out for.
Okay, so we've heard about the spreads in the steel industry and the Goldman Sachs note coming through. But Hadrien, if I were to take your cues on Tata Steel right now, well, we are looking at it hanging around the 590 mark. It's 586 as per the pre-open rates. How would you view trade on Tata Steel currently, considering so much volatility seen in the recent times?
Yeah, so yesterday we have seen a bearish engulfing, and we have seen a bearish engulfing after it just managed to touch its 200-day moving average, so that is acting as a very strong resistance. I would go long on a Tata Steel only if I see Tata Steel trading above 605 levels. That is the resistance that I'm looking out for. Until unless I'm I'd rather be with a JSW Steel or a Jindal Steel from here on, not a Tata Steel.
Okay, we just have 20 seconds left. Jay, what's your top pick for the day?
It's Lupin, definitely. Undoubtedly, I would say that Lupin for a target of 835 with a stop loss of 794.
Hadrien, 5 seconds. What's your top pick for the day?
GMDC for a target of 122.
Okay, so GMDC and Lupin, two interesting ideas from our experts. Gentlemen, stay on. Just taking opening thoughts from you. Mayuresh, take a moment to thank you for joining it today and giving us your thoughts. But here's what the markets are doing on open. About 0.25% higher for the mid-cap, for the Nifty and the Sensex. The Nifty banked to pretty much at the same vein. Let's bring up the mid-caps and the small caps and see what they are doing. Again, no difference. So almost all the key indices start off on the same note. Slightly less than 0.25%. In fact, the Sensex is now flattening out completely, but more green than red on the screen. Hardly any losers, which is the other key thing. Tata Steel is the only one which has some pain, and this is continuing from where it left off yesterday, by the way, on the Bloomberg story. But almost all the other stocks are doing okay. On the gaining side, BPHP and IOC and HPCL, in fact, amongst the top gainers, not BPCL. Dr. Reddy's about 1.5%. SBI, I can see there, HDFC Bank about 1/3%, but no big gainers. That's the other key point, save for certain pharma names, Cipla, Lupin and Dr. Reddy's. So large cap pharma seems to be starting off on a good note, and all marketing companies having a good start in the session today. That's as far as the benchmark indices go. There are 2 or 3 pockets that I think we should highlight before I hand it over to Agam for what's happening to almost all the usual suspects, and they will come up on your screen as well. So select pockets, stocks which did reasonably well in trade yesterday, the likes of AstraZeneca and Alembic Pharma. Both of them will come up on your screen one by one. And AstraZeneca, continuing from where it left off, about 1% higher. Alembic Pharma will come up on your screen. Actually, that also brings me to Stride Sassoon and see what that is doing, because the pre-open rates were looking very robust on Stride Sassoon, about 4% higher. So interesting moves there. Bajaj Finance, just want to pull that one up after having a big day of trade yesterday. Is it gaining further? Well, about 0.5%. So not too much, but doing reasonably okay for itself is Bajaj Finance. Let's wait and watch if it builds on from where it left off. And mind you, just before I hand it over to Agam, watch out for Tata Steel. About a couple of percentage points correction yesterday after the Thyssen Group news that broke on the wires, and another 1% done today. It's something that we'll ask our technical experts too, but 1% off at 582. So that's about 3.5% in 30 minutes of trade yesterday and the first couple of minutes of trade today. Agam, what are you spotting?
Well, Neeraj, the usual suspects, those which were under the ASM, and we spoke about last week, which saw substantial weakness last week. So something like a Himadri Speciality in Rain Industries, both of these advancing by around 2.5%. We have gains in something like an Avanti Feeds as well. That's also up as much as 2.3%. Bombay Rayon, that continues to advance. That's up 4.8%. And DCM Shriram as well, that's up about 3.2%. We have gains coming in Quest Corp as well, advancing by another 2%. On the losing end, again, we have further weakness in JBF, which continues to grind lower. JBF Industries now down 5%, again locked in lower circuit. Kaplan Point looking at some profit taking after the substantial up move that we've seen over the previous few days. And other than that, not too much to speak for. Atul and 8K Miles looking at some weakness, but for now the momentum is with the gainers, despite the fact that the benchmark indices are not showing very interesting, or rather encouraging trends.
Well, interesting. Let's get in opening final thoughts from both our technical experts. Hadrien, to you first. On the open, which is about 0.25%, and a word on Tata Steel, which has declined quite sharply yesterday and in today's session to starting of week.
Yeah, so markets definitely open on a flat note, given the big events that are lined up during the week. So I think we're going to see a more of a consolidation rather than this momentum being carrying forward. So it would be preferably being cautious would not harm at the current moment. As far as Tata Steel is concerned, I think as I earlier mentioned, I would be a buyer in Tata Steel only if I see the stock trading above 605 levels, that is above the 200-day moving average. Till then, I'd continue to remain negative on Tata Steel, and we could see the stock even falling towards the 575, 572 levels going forward.
All right, and Jay, your opening thoughts with respect to the different levels that you want to watching out for?
I think nothing major has changed. We would continue to be bullish. I would say targeting 870 on the upside for the index, and I think yes, as Hadrien pointed out, that a big breakout will be about 10,930 only. Until those levels are not taken off, we will continue to see sideways consolidation or stock specific activity. So yes, I think traders should definitely right now focus on the stocks which are providing good breakouts on the upside, which are there in the momentum, and which are also showing some good reversal with a positive divergence, and stay away with the weaker stocks.
All right, Jay and Hadrien, we'll let you go on that. Thanks for joining us and giving us your views on the markets. And with that, we'll shift focus to yet another very important market voice, Harsha Upadhyaya, Chief Investment Officer for Equity at Kotak Mahindra Asset Management Company, joining us on the show. Harsha, good morning and thanks for joining us. How are you changing allocation in your portfolios right now based on the trends that you're witnessing on the markets?
Good morning. We expect market to be range bound in the very short term. So to that extent, we are not taking any aggressive calls in terms of investments. We are currently following a barbell strategy wherein we have fairly good mix of cyclical as well as defensive sectors in the portfolio. Nearly 50-50 is the ratio between our defensive and cyclical portion of the portfolio. I think even going forward, we'll maintain this kind of allocation until we find more value in the market.
Wow. Harsha, good morning. Neeraj here. Is that value a factor of valuations correcting or the markets correcting meaningfully? Or is it a factor of you seeing an earnings uptick coming in maybe Q1 and maybe even Q2 for you to be completely convinced about it?
Good morning, Neeraj. It can be a combination of both. Either market will have to correct more, or we'll have to see more confidence in terms of earnings stream continuing. Both of which at this point of time are not giving us any great comfort. I mean, I believe that while we have seen a sharp correction in the mid and small cap segment, at the index level, especially large cap index level, we have not seen any correction. So on a relative basis, there could be some more downside that we expect in this basket as well. And in terms of earnings, FY19 is going to be again very crucial. For the last 2-3 years, the street has been missing in terms of overall expectations. Again, we are starting this year with an expectation of more than 22% in terms of earnings growth. 50% of which is going to come from banking and financial segment. So that's a worry, because we are unable to really predict the kind of provisioning that will be required in the banking sector. So at least at this moment of time, it's very difficult to say that we'll be meeting consensus expectations in FY19. So until we find that kind of a confidence, it will be very difficult for us to again turn very aggressive on the market.
Harsha, forget the consensus. What is your gut feel? Will we do 15% or thereabouts, or will we beat that for FY19?
Neeraj, it will be very difficult to predict at this point of time. As I said, if you compare FY19 earnings over FY18, 50% of incremental earnings are coming from the banking and the financial segment, of which, let's say, the retail-focused private sector banks will still deliver anywhere between, let's say, 18 to 20, 25% kind of growth. But the rest of the growth has to come from the public sector banks, the NBFCs, and also corporate-focused private sector banks. That is where I think it's very difficult to put a number in terms of where the final earnings are going to be. So until we get confidence on that number, it will be very difficult to take up prediction on the overall FY19 numbers for Nifty, for example. And also what we have to include would be the kind of negative impact that will be there because of rise in interest costs and also rise in raw material prices, including fuel charges. That's going to shave off some percentage from the earnings as we head into FY19. So currently the analyst estimates don't build in all of these negatives. So that's where we believe it's very unlikely that we'll hit 20% of earnings growth. But whether it will be 12%, 15%, I think it's anybody's guess at this point of time.
Harsha, the monetary policy committees have projected a fairly sanguine outlook despite the fact that they hiked rates. And they remain neutral when it comes to their stance, of course. But what do you make of their commentary, and what impact can your expectations with respect to the rate trajectory have on equity markets?
See, at this point of time, the negative impact of interest rates on earnings is limited, because we have not really seen a repricing of borrowing rates in the market. But that's going to happen over a period of time, and we have already seen first few signs of that. And if you see 1 or 2 more hikes in the market, then I think definitely that gets passed on to the corporate world as well. So that is what is going to shave off the earnings growth for FY19. For full year, as per our estimates, if there is 100 basis points of increase in interest costs, the top 500 companies would see a fall of about 4 to 4.5% in terms of profit growth. While this is a 12-month impact, the entire impact may not come through. The entire 100 basis points is also unlikely to happen. So it will be maybe 1 or 2 percentage points of kind of an earnings hit just because of increase in interest costs. That is what one will have to build.
Right. And Harsha, the other question was specifically with the NBFC space, which has been buzzing. But I talk about specifically the larger cap stocks which have been doing well. How would you deal and what would your approach be when it comes to NBFCs when you consider housing finance companies against, well, other NBFCs such as microfinance perhaps, or other financing avenues?
In NBFC segment, we have been very, very stock specific, not only now, but for the last 2 or 3 quarters. We are seeing risks building in that segment. I think clearly the wholesale borrowing rates are going up. In terms of various business segments, I think the risks are increasing once again. So we'll have to see what's the kind of risk that some of these NBFCs have taken to get supernormal growth in the last few years. We'll be comfortable with only franchises which have retail focus and which have more diversified business segments rather than 1 or 2 business segments. So that's how we are going to play NBFC space. But overall, I think the good days for NBFCs, at least in the short term, are behind us. We are already seeing increase in interest costs and also increased risk in terms of assets.
Harsha, a couple of your peers are launching healthcare funds. You may choose not to or do that, but my moot question is, are you turning slightly sanguine on the prospects of healthcare over the course of the next 2 or 3 years?
We are still going very stock specific in the pharma and the healthcare sector. The reason being, still it's very difficult to predict the kind of earnings impact that will be there over the next few quarters or even next few years, given where the US FDA approvals are stuck. So it's going to be more of a blind bet at this point of time. So we would stay away from that kind of a blind bet at the sector level. But on a stock specific basis, yes, if we find some comfort in terms of some of the approvals coming in or some of the value emerging, we will definitely look at those particular stocks.
Harsha, just wondering, I'm sure a bunch of your ideas worked very well, but what is it that's worked beautifully for you as an investment over the last 12 months and where you still have complete conviction of staying put, either because of the numbers delivery or because of the business momentum and the management commentary in the last 2 or 3 quarters?
I think clearly our retail-focused private sector banks and NBFCs and FMCG names have delivered quite strong returns with possibly much lower volatility than the overall market. So that is one space where we continue to remain invested, and also the management commentary continues to be quite strong. So that is again is going to be the core of the portfolio.
All right. Well, Harsha, in that case, let me ask you a little more about consumption, in this case specifically staples. Will your pick in this also be more stock specific, or would you go ahead and buy staples across irrespective of their valuations, considering the consumption story of India?
No, definitely valuations will always be one filter that we will not ignore. We are looking for stories where we believe the incremental market share gains will continue, where the volume trajectory seems to be on an upward trend. So those are the names that we will have preference to. But again, valuation obviously we will have to keep in mind in every case.
Having said that, Harsha, are you turning a bit skittish on the valuations? I mean, for the last 12 months now, some of these names are trading at least 20% higher compared to their mean averages, which are anyways high. I mean, an HUL or a Britannia or any of these staple names at least. Do you think that divide will stay? I mean, we see that divide even in the S&P 500, right? The clutch of names which are trading at astronomically high PE are the ones which everybody is continuing to favor and they're staying put. Do you think that behavior continues to play out and will continue to play out in FY19 as well?
I think that will continue at least for some more time until we find a broad-based recovery in overall economy and much more sectors participating in terms of business momentum. Until then, I think even with higher valuation, some of these names may get preferred, because wherever there is risk of earnings, the stocks are losing value very, very sharply on any negative event. So to that extent, most of the investor comfort still lies with names where there is earning stability. And yes, I think given the rich valuations, at some point of time there could be money moving out of some of these names into some of the beaten down stocks. But in the last 12 months or so, that has happened quite a few times, but that has not sustained simply because some of those beaten down sectors never really had any fundamental upward trigger. So we are also conscious of this fact, but at the same time, we would like to see some positive fundamental development in some of the beaten down sectors, before which we will not really shift some of the money that is there in FMCG sector, for example.
So there is sorry, but just a follow-up. So there is no hope trade, is it, Harsha? You're waiting for the print to happen.
As a fund house, we don't believe in playing some of those event plays or where there is a 50-50 chance of going right or wrong. Rather, we would wait for fundamental clarity or valuation comfort, and then take those bets maybe in a bigger way, rather than trying to nibble at every beaten down sector and hoping for something externally to impact that particular sector positively.
All right, and Harsha, what's the best way to play the discretionary space? We have addressed the staple space, but discretionary is a much larger. So would autos be the best way considering the volume trends, or is there any other way where you see more value based on valuations?
We continue to play consumer discretionary mainly through auto. The only change that we have seen within the consumer discretionary portfolio is the fact that earlier it was entirely focusing on urban consumption, but for the last 2-3 quarters we have started to look at some of the rural consumption names, and there we have increased our weight, and we remain positive even on the rural consumption at this point of time. Plus, we have also played aviation through some of our portfolios, where we believe the discretionary consumption is really, really strong. Despite the infrastructure constraint that we have in various airports, the passenger growth continues to be very, very strong. And even at these higher crude prices, the profitability of the industry is quite okay. And we believe that that's a structural story to play in Indian context.
Wow. Harsha, that's a sea change, right, from what fund managers used to do when it came to aviation by and large, and Indian aviation in particular. What's the thought process here, though? Do you reckon that the havoc that crude played with the financials in Q4 will ease out over a period of time? I mean, is it also a call that is being taken on what crude does over the course of the next 12 months?
It's very difficult to take a call on the crude price movement, but we believe there is enough pricing power in the industry to pass on some of these costs. We have already seen the market leader taking a cue in terms of increase in fuel surcharge, and that will also reduce some of the yield pressures that we had seen in the Q4. We are not expecting some of these things to happen over a quarter or over next few months, but I think structurally this sector remains one of the focus areas, and if we get more comfort in terms of falling crude prices, then definitely we will add to our position. But at this point of time, we want to be present in this particular space.
Interesting. The export theme, Harsha, I mean, final question from mine at least. The export theme has been dominated by what's happened to IT. I mean, smaller fringe sectors like textiles, gems and jewelry are out of the equation right now. Pharma hasn't been able to cut ice. So it's IT through which I presume people are largely playing exports, maybe to a certain extent auto components. What's your theory here about what happens here on?
Yes, in the current context, I think IT is definitely a defensive sector to look at. And we have also increased our weight into IT sector over the last few months, and continue to focus here since the management commentary has improved at the margin, and also there seems to be some concern about current account deficit increasing, currency being volatile, etc. Under these circumstances, definitely IT seems to be one of the spaces where the volatility would be much lesser. Along with IT, we are also focusing on some of the other individual stock-specific names who are focused on exports, or whose profitability is dependent on rupee dollar rate. Some of the commodity names where rupee dollar rate makes a big impact, we want to be positioned at this point of time. So there is some bit of defensiveness in our portfolio. That's mainly coming because of our concerns on current account deficit and rising volatility in the currency market.
Okay, Harsha, we leave it at that. Thanks for joining us and giving us your views on the markets. And with that, we'll also slip into a short break. But on the other side of the break, we take a look at the growth prospects for Dish TV with Managing Director Jawahar Lal Goel and discuss Sobha's record sales in FY18 and its expansion plans with its Managing Director JC Sharma. Stay tuned in. We'll keep bringing you more.
Welcome back. You're watching Indian Open with us on Bloomberg Quint. It's a flattish day of trade. Almost all the key indices currently as we speak are trading in an extremely flat note. The mid caps and the small caps are not different. On to the corporate conversations. Firstly, Dish TV. The Dish TV Videocon D2H merger is finally complete, creating a direct-to-home company which has a healthy mix of rural and urban presence. The average revenue per user or ARPUs may have disappointed a tad bit in the last quarter, but the management commentary suggests that it is only going to get better from here on. Is that so? We talk about that and more with the man in charge of Dish TV, the Managing Director, Jawahar Lal Goel. He joins us right now on the show. Mr. Goel, good having you. Thanks so much for joining in. You know, I'll take a cue from a report, Mr. Goel, which speaks about Dish TV's recent performance and says that underlying trends are a tad weaker. It is the merger synergies which will drive the stock performance. Would you agree with this?
Well, we had seen, as we spoke on with our investor community, the synergy level is on the track, which is around 570 crore for this financial year and about 750 crore next financial year, which we are envisaging. The ARPU thing has been misnomer for our company because we have been counting the share subscriber number on 120 days due basis. Now we had come down to 60 days due basis, and the total size of my subscriber base is 24 million subscriber. As far as the revenue is concerned, there was a growth, but not that much. But we had the expense of the merger expenses and some few more one-off item. So this was the last year's financial and the last quarter's financials. When we come to the new trend, the coming quarters, we had a healthy the cricket season in this, but parallelly we had a Ramzan period. So these are the subscriber numbers and the revenues that is always based on some events which I always have. You know that we have a churn percentage of about 0.8 or 9%. Which in our immediate competition like cable, they are not yet factoring those churns. So this is one of the criteria which there is a disparity in the industry.
Okay, so so based on the answer that you've given me, Mr. Goel, would Q1 also be a bit difficult to predict because of the events that have happened? And part two of my question would be, how does FY19 look on the revenue front? The brokerage notes seem to suggest that most of the revenue growth will be driven by ARPU improvement, which is probably around 9 or 10% for FY19, the revenue growth that people are factoring in. Are these numbers reasonably believable?
Yeah, this is what we are envisaging, about 9-10% revenue growth in this whole year.
Okay, and Q1 will be a bit mixed because of the two events that you spoke about and therefore difficult to predict?
Well, actually, we don't give it such advisory on the media side, because we have a healthy relationship with our shareholders. We do a quarterly and conference call, and one-to-one we meet them. So as a management, we don't do any guidance on the quarterly, the coming quarter.
Okay.
But I think it should be better, yeah.
Okay, fine. Then I won't press you for that. Let me try and get your thoughts on 2 or 3 concerns that people might have. You mentioned the 9 to 10% revenue growth, largely led by ARPU growth. Now, how would you believe these 3 factors would play out? One, the increase in rural demand, which everybody's been waiting for, but hasn't quite come about with full gusto. Will that happen? And the competitive intensity, one from your natural competitors, from DD free dish as well, will all of that be a risk that you will easily absorb and face?
Well, we in our operator business, we always have a overhang of some event or the other. The free dish is one of them. They have not been able to take a decision on what to do, but as we have to live within the constraint of the industry or external factor and do our business. So we had devised something to tackle that issue as well. There was also OTT or geo impact, which the people have been talking, but we understand that they will be doing on fiber to home kind of a scenario with triple play, which is best suited for high-rise building, but on the row houses and the low density area or B or C class cities, it is a slightly high capex issue. So we have to see and watch how they pan out in Bombay or Pune or city like Gurgaon. Definitely they will take market share. That is the best, that is a good technology, wide technology. But at the same time, when we talk to the content provider, they don't have agreement for providing to the content to the big screen like TV. So small screen contract has been there. But we'll see how this is just a beginning and how the industry pan out. We will accordingly reset our strategy.
Interesting. Mr. Goel, when I speak to the cable companies, all of them are hopeful. I mean, they of course have this broadband revenue base which is separate, but purely on the connections for televisions, they are very hopeful of their ARPUs increasing by a large proportion of their existing customers converging or converting to HD. You, I'm sure, have that process ongoing now for a number of years. How do the next 2 or 3 years look like in terms of conversions from SD to HD and thereby the growth in ARPU that you envisage from your customer base?
Well, in India, we have a big, very huge range of the subscriber. There is a subscriber who do the family viewing, the subscriber who still have a CRT TV, you know, the picture tube TV. And for your viewer, I would like to, I am told that in the country we still have 55% CRT TV population. So out of 150 million TV household, if 75-80 million is still the CRT TV, then question is that high def is how much premium the customer is willing to pay, and those television are not equipped to receive high definition content. So the country is evolving, and it is not overnight. It will be the change from flat TV and CRT TV. We still have market for black and white CRT TV. Yeah.
No, so sir, so I appreciate that. So therefore my question then would be that keeping all of these in mind, and you would know the pulse of the customer over years of managing Dish TV the way you have, what's the kind of growth in ARPU do you envisage as a result of this pure function of a movement from SD to HD? Will that be meaningful?
Well, that's why we had given a guidance of 8 to 9%,
which is for
10% revenue increase.
Yeah.
That is a mix of everything.
Okay. Yeah. No, but what about the next?
That is a mix of everything. That will come from high definition. Yeah. I think it's a welcome step that the cable industry is now are geared up for high definition content and also for data service. So I think, and also they will start counting the churn. They will have their last mile operator registered with GST. So all these things will definitely increase the ARPU.
Okay. My final question, Mr. Goel, and that is on what happens on the operational front and thereby on the bottom line front. You've guided to about 7, 8, 9% growth on revenue for FY19, which is fine. If I'm not wrong, the guidance on EBITDA is about 34 or 35% versus 31% in FY18. What leads you to this confidence in growth in EBITDA? And therefore, what's the kind of subsequent growth in bottom line do you envisage?
See, 34-35% guidance which we had given to our investor community is based out of 2-3 things. One is the synergy on the merger, and number 2 is the revenue ARPU increase. Maybe we will start working on the PAT kind of environment from next year, so that we really have a different yardstick to measure our company. So far we have been on a beta base. From next year we will go on the bottom line total profitability base. This is what I hope, and I discuss with my management team. So these are I think the good years are coming ahead. On data side, I think OTT and all these things, the prices of per GB data has come down as low as 17 rupees per gigabyte, which may not stay there, but even nevertheless, as Dish TV or DTH companies, especially Dish TV, my content cost is 10 rupees per month to deliver to the homes, about 500-600 channels. So this is one area of method of delivery, which is a different technology, which on IP base it is going to be expensive for consumer to consume the content.
Okay, Mr. Goel, we'll leave it at that. Many thanks for joining in today and giving us that perspective, and all the best for FY19.
Thank you very much. Thank you. All the best.
That's the management of Dish TV with their thoughts on how FY19 could be like. Let's try and get that sense from Sobha. It's been a record year for Sobha, and it's buoyed the management to guide for an even better FY19 with nearly 6 to 8 new launches planned across cities. Record sales and revenue growth have had a sanguine impact on the books as well. But well, has that been achieved at a cost? Joining us on the show to answer all of those questions is Managing Director JC Sharma and Jayesh Khilnani from our research desk Johnson to take the discussion forward. Jayesh.
Good morning, Mr. Sharma, and thanks for speaking with Bloomberg Quint. Let's start off with how are you approaching business in FY19, and how do you think that the conditions will be different this year as compared to last year?
See, as far as we are concerned, we believe that this financial year 18-19 should be better on all parameters. We will have more launches. We'll be entering into a new city, and both our verticals, real estate as well as the contracting part, should show growth. We believe that our interest cost should still remain reasonably well under control, interest rates should remain well under control, should be lower than what we have paid in the last financial year. And overall, the balance sheet should show some kind of a healthy growth in line with what we have achieved in the last financial year. As far as the environment is concerned, the Bangalore environment, where we are a key player, Kerala and in Gurgaon, we continue to see traction, sales are happening. Overall real estate market, despite whatever incentives and whatever good things which have happened in last few quarters, still it looks to me it's sluggish on the residential space. On the commercial space, it continues to do well. Maybe that demand supply mismatch and somewhere some uncertainty in the minds of the customers in some other locations, it is affecting. But that also gradually, what we are seeing with the new launches becoming less and less and sales happening, that scenario also should improve.
Now, talking about Q4 numbers, the market was slightly disappointed with the margin levels that you reported. One is what caused the dip in the margin levels, and going ahead, what can be sustainable margin levels that the market can watch out for?
I think market has its own dynamics to interpret or to correct or not to correct. Our margins have been better. We had a revenue stream of contracting which was higher, almost 35% for the quarter against 28% or so for the whole year. The contracting division has lesser margin than the real estate residential space division, so it had some minor impact. But net at the gross level or at the net level, we have had the better margin than the last financial year, that is 17-18 versus 16-17, and going forward also we believe that our margins not only will sustain, they will be far better than what generally you see in this sector.
Mr. Sharma, can you give us more details on the 6 to 8 project launches that you have announced in the Q4 presentation? What is the area under development that you're looking for? What sales value are you expecting? And what will be the timeline of completion of these projects?
Almost 8 million square feet of new project launches we have lined up. The launches should start from the next month onwards. They are at various stages of what you call that process of launching, the sales, marketing, re-registration, somewhere some final approvals, etc., etc. And this is what we are banking upon in this financial year, that these launches should help us to improve our sales in this financial year. As far as the completion part is concerned, normally we are taking almost 4 years to complete a project, and we will be taking the same quantum of time to complete these projects which are likely to launch. The Bangalore will witness highest number of launches, but we will have launches in Chennai, we will have launches in Cochin, we will have launches in Pune, we will have launch in Mysore, and in other cities as well.
Mr. Sharma, despite the fact that in Q4 you reported healthy growth in the sales value and the volume numbers as well, there was a net decline in the realizations front. So does that mean that sales happened in the low cost projects, or was there more discounts that were offered to the customers?
No, it is not the correct and factual interpretation. If you look at, we realized 7,993 rupees per square feet for our products in the last quarter, and our share was 6,457 rupees per square feet. What has happened is, in the last quarter, while selling more, we have also sold the partners' shares as well. So because of that, while recognizing the revenue part What was not belonging to us, we have excluded, and on that basis, you see in the last quarter, small dip. We are not giving any incremental discount. Rather, in some of the projects, though in a very, very small manner, but still we find that we are in a position to push small price increase in those projects.
Mr. Sharma, one final question on the contractual business. Can you give us a sense of, where do you expect the contractual business to be, not only in FY19, but in FY20 as well?
See, we have a beautiful backward integration model. And when we started contracting division, we were only working for one single client for the first 10-12 years. That was Infosys. But in last 6-7 years, we had diversified and we have developed a good stream of income where last year we did almost 850 crore of billing in the contracting side. We have won some new orders. Our order book currently stands at 2,500 crore or so. This quarter we see significant improvement in our contracting margin as well, and going forward to the next financial year 19-20 also we should be doing better than this financial year. So at least from the visibility perspective and the clarity perspective, these 2 financial years definitely will be showing maximum growth on the contracts and manufacturing side.
Thank you, Mr. Sharma, for taking the time out and speaking with Bloomberg Quint. Neeraj, that's the management of Sobha Developers expecting FY19 to be much better than FY18. Back to you.
Thanks a lot for that, Jayesh. And FY18 anyways was strong as well. Well, with that, it's a wrap on this leg of Indian Open. Up next is the F&O show. Stay tuned.